Hey everyone, and welcome back to Finance House. We've all been watching the news, right? Inflation, interest rate hikes, talk of recession. It feels like the sky should be falling on the stock market. Yet, if you look at the major indexes, they're not just surviving. In many ways, they're surprisingly resilient. It's confusing. You see the headlines, you feel the economic pinch, but the market seems to be telling a different story. So, what's really going on? Today, we're going to pull back the curtain and uncover the hidden reason the stock market is still standing. It's a factor that most news outlets aren't talking about, but it's arguably one of the most powerful forces at play. Stick around, because understanding this will completely change how you view the current market. First, let's address the elephant in the room, the obvious challenges. We have the highest inflation in decades, which eats into corporate profits and consumer spending power. To combat this, central banks, like the Federal Reserve, have been aggressively raising interest rates. Historically, this is like hitting the brakes on the economy. Higher borrowing costs mean companies invest less, consumers spend less on big-ticket items, and the whole system is designed to slow down. Logically, this should translate into a bear market, sending stock prices tumbling. And for a while it did. We saw significant downturns. But the market didn't spiral into a prolonged crash, as many predicted. Why? The common explanations you hear are things like investor optimism or the market is forward-looking. And while there's some truth to that, it doesn't tell the whole story. The real hidden engine keeping the market afloat is something much more fundamental: corporate profitability, specifically the incredible resilience of corporate earnings. Despite all the economic headwinds, the largest and most influential companies in the world are still making a staggering amount of money. Their ability to maintain and even grow their profit margins in this environment is the secret sauce. Think about it. A stock's price, at its core, is a reflection of its future earning potential. As long as that potential remains strong, investors have a powerful reason to buy and hold. So how are they doing it? How are companies managing to stay so profitable when costs are rising and consumers are supposedly tightening their belts? There are a few key strategies at play. The first is pricing power. The biggest players in almost every industry, from tech to consumer goods, have built such strong brands and such a dominant market position that they can pass on their increased costs directly to consumers who, for the most part, continue to pay. When the price of your favorite smartphone or coffee goes up, you might grumble, but you probably still buy it. This pricing power protects their profit margins like a fortress wall. The second factor is operational efficiency, turbocharged by technology. Over the last decade, companies have poured billions into automation, data analytics, and streamlining their supply chains. This wasn't just for fun, it was a strategic investment. Now, in the face of rising labor and material costs, these investments are paying off big time. They can do more with less. They can predict consumer demand more accurately, manage inventory better, and reduce waste. This efficiency allows them to absorb some of the inflationary pressures without taking a major hit to their bottom line. It's the invisible work done behind the scenes that keeps the profit machine running smoothly. And let's not forget the global nature of modern business. Many of the giants listed on the US stock market aren't just American companies, they are global empires. If one region's economy is slowing down, they can often find growth in another. A slowdown in Europe might be offset by a surge in demand from emerging markets in Asia or Latin America. This geographic diversification acts as a massive shock absorber. It smooths out the bumps in the global economy and provides a stable foundation for revenue, preventing a localized recession from torpedoing their overall earnings. This global footprint is a key element of their resilience that is often overlooked. Now, let's tie this back to the stock market itself. The major indexes, like the S&P 500, are market cap weighted. This means that the largest companies have an outsized impact on the index's performance. And who are the largest companies? They are exactly the ones we've been talking about. The Apples, the Microsofts, the Amazons of the world. These are the companies with the strongest pricing power, the most advanced operational efficiency, and the biggest global reach. So even if hundreds of smaller companies are struggling, the sheer profitability and stability of these few dozen giants can literally hold up the entire market. Their strength masks the weakness elsewhere and creates the perception of a market that is much healthier than the broader economy might suggest. It's a winner-take-all market, and right now the winners are winning big. So what does this mean for you as an investor? First, it's a powerful lesson to not just react to headlines. While the macroeconomic picture is important, you have to dig deeper and look at the fundamental health of the companies you're investing in. Are they leaders in their industry? Do they have a strong brand and pricing power? Are they efficient and innovative? These are the questions that matter most in the long run. This resilience in corporate earnings is the reason why, despite all the fear, panic selling has proven to be a losing strategy time and time again. Second, it highlights the importance of quality. In uncertain times, capital naturally flows towards safety and reliability. In the stock market, that means high-quality companies with proven track records of profitability. This isn't the time for speculative bets on unprofitable companies. Instead, the market is rewarding businesses with solid fundamentals. This hidden strength is a testament to the power of capitalism and innovation. But it's also a warning. The market's resilience is concentrated at the top. This dynamic won't last forever, but for now, understanding the bedrock of corporate profitability is the key to navigating this strange and confusing market. It's the story behind the numbers, and the true reason the stock market is still standing. Thank you so much for joining me today at Finance House. I hope this gave you a new perspective on what's really driving the market. If you found this valuable, please give this video a thumbs up, and do not forget to subscribe and hit that notification bell so you won't miss our next deep dive. Let me know your thoughts in the comments below. See you in the next video.